Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. Well, I think I have a real treat in store for you today. I'm going to be talking about growth stocks. You know, a lot of you have commented and referred to me as grandpa, and, you know, people have talked about me being old-fashioned. But, you know, I think one thing I want to point out is I have been doing this for 50 years, so I've earned the right to be called grandpa, by the way. I certainly have the experience and the long tenure of investing in stocks and trying to understand this crazy thing called the stock market over all these years. But, you know, growth stocks are a different animal. I'm Mr. Valuation. I often talked about valuation, and I talk about things like the margin of safety with valuation. And I do want to make a point about all valuation. This would apply to what I would call typical, average, everyday growing, high quality blue chip stocks like Johnson & Johnson and Coca-Cola. But it also applies to growth stocks. There's a principle of valuation that's critically important. And the idea is that what you want to do is you want to invest in the business. And this is about long-term buy and hold, you know, fundamental investing, I call it, or value investing. But again, you value growth stocks differently and you look at them differently because the core feature of being a growth stock manager, or the core attribute, is to position yourself so that you fully participate in the growth of the business. But growth at different levels is a very critical dynamic that a lot of people either take for granted, perhaps don't understand fully, or just tend to, you know, overlook, if you will. So I'm going to try to get involved in that also. So I'm going to be talking about how to value growth stocks in such a way that you can participate fully in the growth of the business as an investor. The other side of that is it's different than I would value lower, slower growing or more traditional stocks. I'm going to make that clear. But there's also a real benefit to investing in growth stocks, and that is that you can even overpay for them and still make great money. But I think by doing that, you take on greater risk and, you know, have the potential to earn lower rates of return. So I'm going to cover all those subjects. And as a bonus, I'm going to actually take a look at 7 growth stocks, 6 of which I think are very attractive today. So, you know, as an aside from the lesson of how to value growth stocks, I'm going to give you some, you know, growth stocks you might want to consider and research. So let's go ahead and get started with how to value growth stocks. In my opinion and experience, a great way to do that is to utilize the famous formula that Peter Lynch actually introduced to us in his best-selling book, One Up on Wall Street. And so I posed the question here, is the PEG ratio a good valuation metric? It's a metric that's used quite commonly in investing, and it's, you know, a lot of websites have it. FastGraphs is, you know, going to be incorporating that in our new version, which, by the way, we do expect to launch hopefully somewhere mid to the end of July, early August, if we're fortunate. So anyway, not to get on that, the PEG ratio is really founded in a concept that Peter Lynch introduced in his book, One Up on Wall Street. And he was doing this by talking about the infamous price-earnings ratio. And he says, you know, we've gone on about this already, but here's a useful retirement. The PE ratio of any company that is fairly valued will equal its growth rate. Now, you know, I'm not to try to argue with the, you know, vaunted Peter Lynch, one of the greatest money managers that's ever walked the planet. I do take exception to this statement. I think this statement is spot on if you're talking about growth stocks. Okay, if you're talking about traditional stocks, then I don't know that the P equals growth rate formula really has much value. And he goes on to say he's talking about the growth rate of earnings, and he says a PE ratio that's half the growth rate is very positive. So you want the PE ratio to be less than the growth rate when you're dealing with growth stocks, but it doesn't necessarily apply when you're dealing with lower growing stocks. So what we've done with the FastGraph research tool that, you know, I am a co-founder of as well, and, you know, FAST is an acronym for Fundamentals Analyzer Software Tool. It's to help us evaluate stocks. And I do want to point out, we use 3 formulas in our tool. We use the Graham-Dodd formula, and then that's the primary formula. And this will be used for companies that grow at 5% or less. But then we do use the P equals growth rate formula, which is for companies that are true growth stocks, that I'm, in my definition of growth stocks, I'm looking for companies that are growing at 15% or better. And then we have an extrapolated formula that goes kind of in between the two. This formula will typically add a 15 PE ratio to the graph, which is the historical average for stocks over time. This will actually use the growth rate, and the Graham-Dodd formula will often use a PE ratio of 15 or slightly less. But I don't want to really get into that. What we're focusing on here is the PEG ratio. I think that's the real key point. The price earnings ratio equal to growth stocks is a great rule of thumb formula to use for valuing growth stocks. And let me go ahead and explain and get into a little more detail here about growth, if you will. Growth is really all about understanding the power of compounding and how compounding works. And this is why growth stocks are different animals. It has to do with the power of compounding. Now, it's alleged that Albert Einstein once called it the most powerful force in the universe. And whether Albert Einstein said that or not, compounding is very powerful. And a great way to understand that is to utilize the rule of 72. And let me go through an exercise here, which kind of helps people understand this whole idea of compounding growth, if you will. So the rule of 72 states that you divide any rate of return into the number 72, and that gives you the answer how many years it takes to double. That could be earnings or dollars or your money or whatever, okay? But the point is, it's a really handy rule of thumb formula. How long, and I'm going to use it in the aspect with growth stocks on having it tell you how many years it takes you to double your money. Okay, so I'm going to use a little exercise here that's simply a little metaphor that I created. My mentor originally did this with me, by the way, and he used the number $20 a month because he was talking about back in the day, this is going way back when he said that was what a pack of cigarettes a day cost. So he was saying, that, if you invested what you were spending, what a lot of people were spending on cigarettes every month, here's what you could accomplish. And he picked some very careful math here, which I'm going to copy. And I'm going to, first of all, do this with 36 years. And I'm going to call this a hypothetical working life of the person. And I'm going to assume that you earn exactly 10% a year on your investments. Now, if you invested $20 a month or $240 a year and did it for 36 years, your net investment over that time frame by putting that money in every year would be $80,000. Okay, and then I posed the question, how much would you have if you doubled your return to 10%? Okay, in other words, if you earn 10% a year, this is what investing $20 a month would grow to. Let me clarify that. It'd be $80,000. Well, how much would it be if you invested and earned 20%? And the answer is it would be $1.5 million or 19 times more money. So at 10% investing $20 a month over a lifetime, we're calling it 36 years, you'd end up with $80,000. If you earn 20%, which is growth stocks, this would be the traditional stock market, which is I'll call this an aggressive rate of return. The average return on stocks is 6 to 8%. Some people have pushed it as high as 8 to 10%. So I'm using the upper limit there to be to give the market some advantage, but growth stocks grow faster than that. And again, I use the definition of 15% or better. So I'm using 20% here, but I'm using it because I want you to see the easy math here. But by doubling your rate of return, the point is you make 19 times more money. How come 80,000 isn't just 160,000? That's what a lot of people originally think about when they're thinking about it. But here's why it's 19 times more and not just double. So let's go through the math and we'll talk about this rule of 72 because compounding is all about compressing time. So if I earn 10% a year, divide that into 72, that means I'm going to double my money every 7.2 years. But if I earn 20% a year, divide that into 72, I'm going to double my money in 3.6 years, which is precisely half the amount of time. So the point is, over my 36-year lifetime, earning 10% a year, I would get 5 doubles of my money. But if I earn 20% over 36 years, the 20% number, I would get 10 doubles of my money. And so here's how that works. If we just follow the money, follow the very first dollar, because this is the easiest way, I think, to comprehend the power of compounding. Your first dollar at 10% over 36 years would double every 7.2 years. So that means that first dollar you invested would grow to $2, one double, 4, 8, 16, 5 doubles would bring you to $32. So your $1 would increase 32-fold over 36 years at 10%. But if you double your rate of return, now your money doubles every 3.6 years. So instead of only getting 5 doubles, you get 10 doubles. So in essence, you get double the double. So that $1, instead of growing to $32 with 5 doubles, it grows 64, 128, 256, 512 to 1,024. So that dollar is 30 times more money at 20% than if you invested that same dollar and only earned 10%. Now remember, in my formula here, I talked about investing $20 a month or $240 a year. So I'm only following that first dollar here because I believe that will give you the power of compounding and the true understanding of how compounding works and how doubling your rate of return does far more for you than double your money. That's why growth stocks are so important, because what you're doing is you're compressing time. You're not doubling your money by doubling your rate of return. You're doubling the time, or you're cutting in half the time it takes your money to double, which allows you to double the doubles, not double your money. And that's why that's so important. Now, a compounding table adds further light to this, so I want to go over this a little bit. This 15% threshold is really where I think you start seeing the power of compounding. I'm going to do this just for a 10-year time frame, and I'm using increments of 5, 10%, then I go 11, 12, up to 15, and then up to 20, and there's that 20. So here's your 10% number and your 20%. And this is just in a 10-year time frame. You know, what you see is 10%, your money doubles every 7.2 years. So $1 turns into $2. You know, $1.95 in 7 years, add 0.2 of a year and you get to $2. By year 8, it's over $2. In 10 years, it's $2.59. But at 20%, that dollar doubles every 3 years, so your money's double 3.6 years. So your money by the end of year 4 is over $2. And of course, by the end of year 8, it's over $4. It would be up to $6 in the end of 10 years. And of course, if you could earn 30%, that's kind of important for this presentation, the numbers get even more powerful because you're even going to grow your money significantly faster. So the power of compounding and understanding it is really the secret to understanding how to value growth stocks. So I've put together a little portfolio here, and I've got 7 growth stocks on here. The companies are Lithium Motors, LKQ Corporation, Alibaba, the Chinese company, Facebook, Starbucks, Etsy, which I'm going to kind of feature at the end of this video, and Amazon. And Etsy is kind of the Amazon of people that custom design or custom manufacture their own products. So let's go ahead and go through these. I've picked a specific order here because I want you to see some sequence. But before I do that, let's look at the portfolio review. I want you to notice these companies range from just below investment grade to A+ and AA- with Amazon. Alibaba's rated A+. Facebook has no rating, and neither does Etsy. But I'm going to show you some fundamentals about Etsy. If you actually put it through the strategies of the rating agencies like Standard & Poor's, Etsy would actually end up being an A+ rated company. So, but I don't want to get too much into that because that's not the purpose of this video. Now, what I'm looking at is PE ratio equal to or less than the growth rate. So I do want you to see that here. You've got Lithium Motors at a PE ratio less than its growth rate. You've got LKQ. Now, its historical growth rate has been better than this. And I'm not looking at just the 5-year, the 10 or 20-year growth rate's been better than this. But I do want you to see that the P equals growth rate formula is what I'm going to be focusing on. I want you to understand throughout this video. Okay, so let's go through these companies very quickly here, utilizing the Fundamentals Analyzer software tool, FastGraphs. And what I first want to start out with, I'm going to start out with Starbucks. Now, FastGraphs automatically adds the PE ratio equal to growth rate formula. That's what you see here. This is a PE ratio of 18% on the orange line. And you can see that, you know, during the recession, it did get to that, but the stock tracks its earnings. I want you to know that the price goes where the earnings grow, but the reality of it is that, you know, the valuation of this stock has been higher than that. The markets tended to put a premium. I'm going to scroll out the coronavirus numbers here and make another point here. This is where I'm using now a PE ratio of 20. We'll call it 19.97. We'll call it 20. And this kind of gives you a better reflection of Starbucks as well. But here's the point I want to make about growth stocks. It goes back to that power of compounding and the compounding tables I showed you earlier. So this stock from, Starbucks from, the beginning of, or the October of 2000, this has the September fiscal year, by the way, to the end of 2019, prior to the coronavirus, pandemic, this stock grew at 20% a year. Okay, now you can see that it's been a tremendous growth stock over this time frame. If I measured performance here, I'll use the calculator tool here inside. This would have averaged almost 17% a year, turning 10,000 into 184,000, counting dividends, which, by the way, they started paying in 2010. Okay, prior to that, it was a pure growth stock. But here's a lesson in growth stocks I want you to understand. If you want to participate fully in the growth of this company, then you need to buy it when it's trading at a valuation that is equal to or below its growth rate. If you pay a higher price than that, a higher value, here's a very high PE ratio, you're going to earn less. So here's a case where the company grew 20% a year, but your investment only grew at 16% a year. Okay, that's because you were paying a premium valuation to buy the stock. But here's the other thing about growth. Here's why growth stock investing can be so attractive if you have the mindset and the psychology to play this game. If I go here and pick a very high PE ratio on Starbucks, if I bought it on March of 2006, I'd have paid a PE of 55. The price would have been 18. If I go approximately 4 years later, not just precisely, but close enough, I would have turned $10,000 into $3,600. Okay, now what happened here? We obviously entered the Great Recession, and Starbucks' growth rate was slowing down a little bit over this time frame. They actually had a negative earnings growth rate during the Great Recession, and of course the end result of that was you had the stock go through this collapse here for 4 years. But if you're a buy and hold investor, the power of compounding came into play, and then Starbucks all of a sudden started to increase in value. So ironically, if you'd have bought that stock here and held it, to this, recent time frame here, you'd have earned almost 13% a year annualized on your money, turning $10,000 into $50,000 over this time frame, or 5 times your money, since 2006. That's a pretty, 13% is nothing to sneeze at. But now here's the power of valuation. Again, this is when the company grew at 20% a year. I want to remind you of that. Well, it actually didn't here because I'd have to adjust this, and I could do that for you and adjust that out here. At this point in time, the company was actually growing at 16.7% over this time frame. Okay, but the point I want to get across here is not that. Here's the point I want to get across. Had you bought the stock at that same time frame, okay, where you paid this, PE ratio of $55 a share or 55 times earnings, I'm going to hit it close enough there, and went through this, if you were willing to walk through this horrible time frame where you'd have lost, almost, over half of your money, the result is because of the power of compounding, this company grew and the growth bailed you out because it wouldn't have taken you long to actually have a decent positive rate of return of over 7%. But here's the kicker. Had you waited and actually, had the foresight to buy this stock at a very low PE ratio here that was more consistent to its growth rate, and I'm going to buy it here right at its growth rate. I'm not going to pick the bottom here, and held it through this time frame, this same time frame, you now turn $10,000 into $128,000 counting dividends. And the reality of this is that you ended up with over, a 10 bagger. This is the classic Peter Lynch 10 bagger. You owned it for 3 years less time here, but you made substantially more money because now you participated fully in this company's growth, and you actually got some, what I like to call false profits here. But the point is, a very fast growing stock can bail you out of even a bad decision by simply, if you're willing to hold it long enough and trust the fundamentals more than the stock price. So that's the lesson I wanted to use with Starbucks. Starbucks is the one company out of the group here that I'm talking about that I do believe is significantly overvalued. I do think it has good growth potential going forward, but I don't believe the company has the growth potential that is going to justify buying it. Now, if I go back to this tool here and scroll out some of these years here and go back to this 20% number, I can take my forecasting calculator and I could go ahead and put 20% growth in here. Again, this is how you value growth stocks is the real lesson. This isn't really about Starbucks. So even if Starbucks grew at 20% a year, you would earn about 5% on your money if it traded at a 20 PE out here. If it traded at a more normal PE ratio of 25 or 30 that it historically has at, you could earn even double-digit rates of return. But again, you'd be taking a lot of risk. So let's move on and let's look at some growth stocks that are kind of interesting here. And I think there's some real great lessons here. This is Lithium Motors, and I'm going to quickly go into the company's website here. As you can see, the company sells vehicles, okay? And the way to make money in the automotive industry is to buy these dealerships like Penske or Lithium Motors and not necessarily invest in the manufacturers like Ford or GM. But here you're coming out of the Great Recession. You've had a really great growth story here. I do want you to notice that this company has grown tremendously. So I'm going to scroll this, right up to the Great Recession, get rid of some of this negative data that was coming into the Great Recession. I'm going to do one more year. And what you've got is a company growing at over 40% a year, which is obviously aberrant because you had some really big numbers thrown in here. So I'm looking at Lithium Motors being a 20% plus grower. It traded normally at around a 14 or 15 PE, but its performance over this time frame was the 26% number that I talked about, participating in the company's growth. That's pretty consistent with the 22% growth, but the stock has become reasonably inexpensive. It's looking, the long-term trend line forecast is for 30% growth on the company. The near-term forecast is for over 20% growth. That's 29% growth this fiscal year, followed by 8 and then recovering to 25 going forward. So if I take all this growth and I kind of blend them together, the estimates, near-term estimates plus the long-term growth rate, you've got a tremendous opportunity to invest in a very fast-growing company here that's trading at a reasonable valuation. Now, I want to make another point. This stock has typically traded at around 14 times earnings. So if I look at this stock, not PE equals growth rate in this case, but based on a 14 or 15 PE, I still have the ability to make double-digit 20% plus rates of return annualized over time, assuming the company does this. But this is the power of compounding. That's what I really want to get across here. This is why stocks like this have generated such high rates of return, because they've grown very fast, like I showed you in the beginning here. The next is LKQ, and this company actually is a distributor of auto parts, junkyards, and things like that. A lot of people don't like it, but this has been one of the most consistent growth stocks, and I've owned this stock for years and, went through a rough time, and this is where a lot of these cynical, anti-value investors, if you will, like to talk about. This company is a quintessential example to me of value and value with a growth stock. Here we've got a 20% grower. It's grown historically at 19.96%. So if I use the P equals growth rate formula of 20 and the orange line drawing it at 20, which is 19.96 rounded, I see this consistent, I guess you'd call it proof of the importance of valuation. The stock got overvalued into the Great Recession and it fell back to fair value. Then it tracked itself. Then it got overvalued again and then came back into fair value. And then it got undervalued for a period of time when they had kind of a flat year in 2017. But then they started growing again, so the valuation got high. And then we went through this period, and of course we even entered COVID-19 here, which is this period right here, where the stock was undervalued for a long period of time. What a marvelous time to buy a growth stock like LKQ Corporation when you could buy it at these low valuations. So I'm not going to pick the low here. I'm going to kind of go just coming out of COVID. And, here you get this chance. You're making, you've had a 90% increase from April of 2020 to June of 2021. In this very short period of time, annualized return of almost 78% a year, just because you bought this at fair value. But even if you'd have bought it at an attractive value back here and went through all this problem, now the stock's moving back towards its fair value, the blended PE is 17.59, you make over 11% a year. But the point I also want to make is if I get this stock back to fair value, then I'm making 13 or 14% a year, which, by the way, will be what the growth rate would equal here if I did that. Now, looking at it going to the future, it's expected to grow at around 11% over the next few years. But I don't really have a 3 to 5 year growth rate. So I'm going to go to Yahoo Estimates here, which I like to do, looking for another estimate. Yahoo analysts believe this company can grow at 33% a year. Now, this is what is tricky. I'm going to use 33% a year. I'm going to use my custom calculator, which is a tool that allows me to do what-if scenarios. So now I'm looking at LKQ Corporation. If it grew at 33% a year, this would be a tremendous opportunity to invest in this company at a PE of under 20 right now. Now, let's assume it only grew at, say, 20% a year. Let's say these analysts were really exaggerating what they thought it was. So at 20% a year, I would still have a great investment. And if I look at this company from a standpoint of its historical compound growth rates, I've got 20% growth rates, quite often. Now, the older it gets, the bigger it gets, my growth rates are a little less here. So I can run all these different scenarios. But the key is if I can get 15% or better growth, which is expected for this company over the long run, this could be a tremendous opportunity to invest in a stock like Lithia. Now, I want to move on to Alibaba, the Chinese company, and often referred to as kind of the China Amazon, if you will. So here we've got BABA, and it's a US ADR. It's an American depository resort. It has very little debt, A+ rated. And once again, you see this P equals growth rate. The business has grown at 23% a year since it's been public. The stock has, averaged about a 32 multiple, but you can currently buy it at a 21 multiple, which is consistent with its growth rate. They're expected to have a flat year here. Again, I'm sure COVID related, but the long-term growth rate of this company is expected to be 27 or 28% a year. The near-term estimates are a little lower. So if I go into my custom calculator and I combine these two, in other words, I believe you got some short to intermediate term weakness, but then followed by great strength going forward. What a tremendous time to be looking at a company like Alibaba. It's a growth stock that you can buy at an attractive valuation because the market has brought it down. The key here, what do you believe the future growth is really going to be? But remembering the power of compounding, if it achieves those growth rates, what a tremendous stock to invest in over the long run. Facebook now is really a classic P equals growth rate stock. Growth rate's been 34.42%. If I use a 34 PE, you can see that the price tracked that almost perfectly. But if I shorten the time frame, the growth rate slows down to 29%. Now I'm using a P equal growth rate of 29. I'm also using a normal PE that's about that same number. But, looking here, this gives me the chance to make double-digit rates of return going forward, assuming the company achieves those growth forecasts. Now, the long-term trend line growth is expected to still be over 20%. The near-term growth is expected to be over 20%. So, what I've got here is a company that if I go ahead and, do my custom calculator and blend the two together, I've got a company that's capable of generating double-digit rates of return for me based on the fact that it's still a very fast-growing company. So here's another one that I think is I think it might be a little overvalued based on near-term estimates, but it's probably a good value if you're willing to be a long-term investor. And then, of course, I'm going to look at Amazon. And as I point out, Amazon has, not really tried to achieve profitability, but they've generated operating cash flow growth of over 29% a year. And so here I'm using priced operating cash flow. You can see the correlation, how the stock prices perfectly track that over this time. If I look at forecasting, it's expected to continue to grow cash flow at over 29% a year, which is, I'm sorry, take that back. That was historical growth at over 17% a year. The long-term trend line growth is over 26% a year. And if I, use the custom calculator and put the two together, I've still got a tremendous opportunity to invest in Amazon. But again, it's a very powerful growth story, and it's the compounding of its cash flows that has generated the performance that has really been very similar to its historical growth rate. 10,000 would have averaged over 30% annualized rate of return with no dividend, going back from December of 07 to currently. That's this time frame that I'm drawing here, and that's right in line with the 29.5% growth rate of cash flow that the company has generated. So I'm going to end this video with kind of a bonus here, and I want to look at an Etsy, and I want to incorporate what I said about Starbucks in the beginning with Etsy. Now, Etsy is considered to be kind of an Amazon of home goods. Okay, this company is a very interesting company. What they do is they're American retailer of homemade goods, and people that build vintage items, craft goods, and they sell them on Etsy. Okay, and that will include things like jewelry, craft supplies, entertainment items, home and living items, furnishings, and things like that, vintage items, even children and baby goods. So the company's really a pretty interesting company, and it's had a tremendous growth rate. Growth going back to the time frame I'm drawing here, which is 2018 to current, has averaged just under 49% a year. The performance of this company has done even better than that. It's averaged almost double that in terms of growth. And that's simply because, it was trading at a PE of 49 here, and now it's trading at a PE of 59. Okay, but the company is still expected to grow going forward. And that's what's interesting about this company. The long-term growth rate by analysts are expected to be similar to what its historical growth. Now, on FactSet, I want to make a point here. I'm only showing 10% growth. But once again, if I go into Yahoo, which uses Reuters and gets a different set of analysts, here now I get 53% growth, okay, which is obviously a big dichotomy there. I ended up coming up with a number of 49% growth, which was consistent with this historical growth rate. So I'm just doing what-if scenarios here. I want to be clear about that. But if this company does grow at 30, 40% a year going forward, it's got tremendous opportunity. This is 49% growth, rates of return, very similar to what it has historically. If I, shorten this to 30% growth, cut that growth rate down dramatically, I still have the opportunity to earn double-digit rates of return. This is the power of compounding that I'm talking about. Now, a couple of things about Etsy. I'm going to turn to the new version of Fast Graphs here and give you a snippet into what it's able to do. One thing I really like about this company, I mentioned to you in the beginning of this video, it has the ability, to effectively be an A-rated company, because it has a very, very low 30-year historical bankruptcy risk. This is from my good friend Adam Gallus, who's known as Dividend Sensei on the website Dividend Kings, and he likes to look at stuff like this. This company has a very low bankruptcy rate, and let me kind of prove that to you. This is cash versus total debt. This company has more cash on hand than it does total debt. All right, so it still has tremendous resources, tremendous ability to grow. And so this might be the featured growth stock here because it's still small. Of course, at 21 billion, I'm calling it small, but it's still young. I guess if you compare that to $1,654 billion, Etsy would be small. So it does have the ability and the room to grow. But anyway, this is how I value growth stocks. I'm looking at P equals growth rate, and I'm attempting to find companies that can grow their business very fast. Even if you overpay for a growth stock, which is the end of my message here, you can still make great rates of return due to the power of compounding. There's more risk in growth stocks, but there's also more reward potential, as I've shown you throughout this video. Thanks for watching, and look forward to talking to you guys again real soon. If you like this video, please give me a like, ring the bell, subscribe to my channel if you haven't. But growth stock investing, especially in an overheated market like this, can be very profitable if you can find the companies that have the growth potential and valuations that are at least somewhere resembling what their future growth might be. If you can find them at growth, you've got a really home run. You've got that ability to get that 5 and 10 bagger that Peter Lynch talks about. Thanks for watching.